So welcome to our second webinar on cost transparency in partnership with the PLSA. Today we're going to provide you with a brief overview of the market landscape, why we should care about cost transparency as trustees, which I have a pretty strong view on. We will walk you through the cost transparency journey and talk about value for money. So just to introduce ourselves, I am a trustee of a small DC trust scheme, and I've gone through this cost transparency journey, and I'll be sharing some of that with you.
So hi, my name's Scott Foster. I'm a cost transparency specialist, and I'm the technician that's been helping Pat through her cost transparency journey as a DC trustee. What my role is to be on the ground helping pension schemes collate and report the total cost of ownership of running their pension scheme. I've been doing that for 2.5 years. As a technician, what I can help with today is insights on data aggregation, data analysis, and data verification, with the end goal of reporting all of that cost information back to a pension scheme with key insights within a 12-week period.
The discussion around cost transparency has actually been going on for some time. Since 2015, the governance bodies of DC workplace pension funds have been required to obtain information on charges and transaction costs and explain the extent to which they offer good value for members. In 2018, we saw new regulations for DC schemes to report their charges and transaction costs borne by the members on the Chair's statement. From the 1st of October of this year, we now have the obligation to publish our Chair's statement, including the charges and transaction costs borne by members with illustrations of compounding cost and the impact to members over time. For DB, there is currently no obligation to report charges and transaction costs. However, the recent House of Commons Work and Pensions Committee report recommends that trustees for all DB schemes undertake the same scrutiny of value for money as we do for DC today. We expect DB pension schemes to have the same obligations in the very near future. Now, the LGPS are a very good example to us all. They launched a transparency code in 2015, including a framework and a template. If an asset manager didn't sign up to the code, they just didn't get the job. The regulators are actually driving better governance across the financial sector. So, for example, the TPR's recent consultation on governance and trusteeship. Cost transparency is not just about meeting our regulatory obligations. Cost transparency is also about good governance and more informed decision making. We actually have a great saying: you can't manage what you don't measure. So Scott, I agree it's important to care about costs as a trustee from a regulatory obligation perspective and good governance. But as a trustee, why do you think I actually need to carry out a full cost transparency review?
So Pat, I really believe that you should carry out a full cost transparency exercise because pension funds are long-term savings vehicles and costs in the long term can compound over time. In our analysis of cost data across a range of pension schemes in the UK and in the Netherlands, we have found that transaction costs can make up 25% of those investment costs. And those investment costs add up over time and can have a negative impact on member outcomes. It's important to note here that those transaction costs have previously never been reported back to the pension scheme. As well as that, in our analysis of cost data, we've typically found that pension investment costs are 3 times higher than in-house estimates. And that's a startling statistic.
That is a startling statistic. Thank you, Scott. So as I said at the beginning, we went through this journey for the DC pension scheme I'm a trustee for. We've collected all the costs, including transaction costs, and reported them on our Chair's statement. But it wasn't straightforward, and we needed help to collate the costs, check them, and create the section of the Chair's statement, including those illustrations of the compounding cost for members. So where did we start in the UK? When DC schemes were first required to obtain information on charges and transaction costs, a simple template was created, the DCPT. However, there were multiple templates in circulation. There was the Dutch, for example, the ILPA one for private markets, the LGPS in 2017. And what that meant is that even when we did receive cost data from our asset managers, it was in different formats. Apart from the fact that no duty was placed on asset managers to disclose this information to us. It was a challenge as a trustee. One of the key recommendations of the FCA Asset Management Study was to implement a more consistent and standardised disclosure of costs and charges to institutional investors. In 2017, the FCA formed the IDWG Group, the Institutional Disclosure Working Group, and their job was to implement a standardised framework and a set of templates for cost data collection. In 2018, the IDWG produced some recommendations and passed the baton to a newly formed group called the CTI, the Cost Transparency Initiative, formed by the PLSA, the IA and the LGPS, and their job was to finalise the framework and templates. This was finalised this year, and we have got a set of templates were launched in May of this year with an aim that be adopted by the industry as a standard by the beginning of 2020. The FCA had also placed a duty on asset managers in 2018 to disclose transaction costs to pension schemes. So we now at least have a standardised framework and a consistent methodology for the collection of costs, so we as trustees can compare apples against apples. So Scott, we now have these CTI templates. So could you talk us through that main template?
Yeah, absolutely. So we've agreed to use the Cost Transparency Initiative templates as the industry standard to collect cost transparency data for our UK pension scheme. What we'll need to do is to collect one CTI or Cost Transparency Initiative template for each individual investment mandate. So if a pension fund has 30 mandates, they're going to have to collect 30 individual templates to report all of their cost transparency information. On the CTI templates, there's 10 key cost transparency related items there. And the key things that we need to focus on as a trustee are 5 items that I'm going to highlight. Number 2, which is portfolio investment activity. That covers asset values, sales and purchases, and really gives context around the costs that are being reported by your asset managers. Number 3 covers all of the transaction costs related to your individual investment mandate. There's been typically less transparency on those costs in the past, and they typically cover explicit transaction costs and implicit transaction costs. Cost item number 4, ongoing charges, covers your AMC or annual management charge, your governance, regulation and compliance fees, administration fees related to your investment products. The next thing I'd like you to focus on is number 5, incidental costs. To make it easy for us, that's another way to say performance fees. Number 6, 7, 8 and 10 covers fees which are good to know but are not always applicable, but it's good to collect those fees from your asset managers if they're relevant to your investment products. The next thing and the last thing I'd like you to focus on is non-cost items which cover gross and net returns, and that's typically found in performance information. So what I'm going to run through now is the data collection process for collecting all of this cost transparency information via the CTI templates. So first things first, let's keep it simple. The first step is to make contact with your investment managers and your scheme administrator and highlight that you're going to begin a cost transparency collection exercise. For your investment managers, you're collecting investment cost data via the CTI template. And for your scheme administrators, you're looking to collect pension administration costs. That's typically what you already report in your annual report and accounts. The next step is to set a deadline. I like to say around 3 weeks to collect all this cost data, allowing a 4 to 6 week grace period. The reason I say that is if you collect 50% of all the cost data you need to within the deadline, you're doing pretty well.
So Scott, can I ask a quick question here? Why would I want to collect my pension management costs when they're not included in the CTI template?
Well, you're quite right, Pat. The administration costs are not included in the CTI template, but in the nature of full cost transparency, and if you're looking to capture what's called the total cost of ownership of running the pension scheme, it's a relevant cost item to include and aggregate into your cost transparency exercise. This cost data from an administration perspective is nothing new. It's typically found in your annual report and accounts already. And to be clear, the regulation states that for cost transparency reporting, it should include all costs that are borne by the members. So the next step in data collection is, once you've sent out all those requests, is hopefully the managers acknowledge that request. However, that's not always guaranteed. In the case where some of the managers don't respond on the first go, it's always good to monitor those managers, remind them of the deadline, and answer any queries that they may have regarding the cost transparency exercise that you're conducting. In my experience, some send in that cost data next day, no questions asked. However, some won't even acknowledge that data request, simply sending in the cost data on the deadline date, close of business. So the next question here I always get is, what should I do if I don't receive the data from my asset managers? Well, this can be a tricky question to answer, and asset managers have been getting better and better over the past few years in reporting cost transparency information to pension schemes and its service providers. It's important here to be clear with your asset managers what you require, what templates you want to use, and what level of detail you need from them. The CTI does a good job in highlighting mandatory fields. And remember, it's also important to highlight your regulatory obligation to collect and report this cost data for your value for money assessments. However, in collecting all of this cost data from asset managers, not all will adopt the CTI templates straight away. And we have found that maintaining flexibility in the short term will only increase your chances of collecting that cost data from all of your investment managers. The next key metric to look at beyond the cost data is that qualitative stuff. What's the timeliness of my asset manager's submissions, and what's the quality of data that I'm receiving from my investment managers? Are they in line with my expectations on what good cost transparency is about?
So Scott, that all sounds fairly straightforward. But what are the real challenges that you have actually faced as a technician?
So as a technician collecting cost data across a range of mandates and pension schemes in Europe, what I have found is that asset managers can tend to have teams of people working to produce these cost transparency reports. We're reaching out to one relationship manager there, but it's not always them that's conducting the full cost transparency reporting exercise, unless it's automated by a machine. What I've also learned is that data systems aren't always aggregated at the asset management houses. And so they're trying to pull different bits of data all within the same reporting period to populate that on one report. That's not always an easy task and does take some time. Again, as I mentioned previously, not all asset managers will report the cost transparency initiative templates straight away, especially those overseas managers that have never even heard of it. In the meantime, and in the short term, I believe that schemes and their service providers will still be receiving cost data in legacy formats, such as the LGPS Code of Transparency, the DCPT templates, the PRIPS templates, and the MiFID II templates as well, that all came out in 2018. The bottom line here is that cost data can come in all shapes and sizes from your investment managers, and it's important to remain flexible in the short term. It can be frustrating, but in the end of the day, I believe that pension schemes are entitled to receive that cost data now that it's a regulatory obligation, and the industry is making good progress to make sure that that happens.
So Scott, a few challenges there. But how do you actually, as a trustee, for example, confirm accuracy of the data that the asset managers are providing you, or if it's correct? Tell us a little bit more about that.
So you'd like to think I've sent my data request to all my investment managers. They've come back with the data in the CTI format and the data's in. Job's done, right? Well, that's not always the case. In my experience as an analyst and a specialist working on cost transparency, there's layers of validation and analysis that go into the cost transparency templates that we do receive from the investment managers, especially if they're not in the standardized CTI formats that we've requested. I'm going to give you an example here where a UK pension scheme requested some cost data from an investment manager. The investment manager came back with a fully completed LGPS template. However, there was no management fees reported that year. That field was 0. It was my role as an analyst helping the pension scheme to make sure that all the information was as accurate as possible. So I went back to the asset manager to confirm if indeed the management fees are 0. The funny thing is the manager came back fully apologetic, saying that we've overlooked that, and indeed there are some management fees that came out to around £900,000. So what it shows there is that there's real value in challenging the cost data that you receive from the investment managers in whatever format it comes in. And there's real value in being familiar with what is being collected on those cost transparency initiative templates and other. Technology can really help with that. If you've got a database to cross-reference the costs that you're receiving year on year, that will really help. The final thing, once you've collected all the cost data, you've added some layers of validation and analysis, is that those 30 sheets should be ready for review for your value for money statements and regulatory reporting.
Okay, Scott, so now I have 30 templates for the investment costs and the costs you collect on the CTI template. That's a lot of data. As a trustee, where do I start with these 30 templates and how do I consolidate it and how do I use that data?
So now that we've got 30 sheets for 30 individual mandates, you're right. The question is, what's next? Here we typically advise to begin the cost consolidation exercise and analysis piece to really work on assessing value for money and your regulatory reporting obligations. What we typically do here is pull together those 30 individual Excel sheets into one aggregated client account template that is provided by the CTI group. But in my experience, presenting this cost transparency information in board meetings to pension schemes or investment committee meetings at pension schemes is I've got a 30, maybe even 20-minute slot to look at all this cost data. It needs to be reviewed, interpreted, and at the end, decisions need to be made on that cost information. And what really can help here is pie charts, tables, scatter graphs that all really bring that cost data off the Excel sheets and really brings it to life. There's real value in dashboarding here that will really enable a trustee or an investment committee to make informed decision making and really drill down into those individual costs that we're collecting from the investment managers. So the next graph here that we're looking at covers everything put together. Here we're showing what's called the expected investment costs that a pension scheme would typically capture if they were to do cost transparency on their own. And after a full cost transparency exercise, what the actual investment costs have come out to. The chart you're looking at now represents a universe of cost data from 72 UK and Dutch pension schemes, representing 230 billion worth of pension assets. What you can see on the far right hand side is investment management fees, which make up 60% of the total investment costs related to the scheme. Schemes are pretty good at capturing that information, and it typically covers the AMC or annual management charge, as well as those performance fees if the asset manager beats a particular benchmark. As well as that, it's useful in our cost transparency analysis that we uncover other miscellaneous cost items. That makes up around 5% of the total investment cost base, as well as that general investment costs, which can make up investment fees, investment consultancy fees, custody fees, and performance measurement fees, for example. And as well as that, it's always the case that a big chunk and the big reveal is those pesky transaction costs. They can make up 25% of the total investment cost base for the pension scheme's investment costs, and it typically covers explicit fees and implicit fees as well. The next graph we're looking at here is the value around benchmarking, and this is a good segue into our next conversation on value for money. Here you can see relative position to a universe of cost data, and here a pension scheme can really show its real value relative to what its peers are performing like from a cost perspective. You can look at this from an investment cost perspective. You can even drill down into the management fees, the transaction costs, and the performance costs. You can drill down by asset type, and this will really help those value for money assessments that DC schemes need to continue to do as a part of their regulatory obligations.
Thank you, Scott. So I think the next big question is, what is value for money? So as per the Work and Pensions Committee report, they'd repeatedly heard there is no clear definition of what good value for money means for pension schemes. This can depend on personal opinion, interpretation, and attitude to risk, return, and of course, costs. The report also refers to trustees to have mistaken costs as value for money, and that therefore have been driven to choose the lowest cost product rather than the best performing and or the appropriate quality service right for their membership. The report also recognises without agreed definitions, it is not possible to make effective comparisons. Now, we're very aware that the definition of value for money is being looked at by the industry bodies and the regulators. So let's hope that we get some guidance in this area very soon. The message here, and the one that we always give our pension scheme clients and for trustees, is that don't look at costs in isolation. Please look at them in context of the service, the return, and the risk appetite at a minimum. So Scott, just to finish off, when we were looking at investment costs as trustees, when we don't have a definition of value for money, and these investment costs make up 75% of the total costs, how do you think we should measure them?
So although value for money is not strictly about looking at costs, and you've got to factor in all those other items that Pat just mentioned, when looking at costs specifically, you can begin to assess value for money of these individual cost items that are captured on the CTI template. For example, transaction costs, you have those explicit fees. And here there's value in benchmarking those fees to see if they're in line with your expectations and are fair as to the market rate. When looking at those implicit trading fees, that stuff that's captured in MiFID II, there's real value in assessing the best execution of your investment managers. Are they getting a good price on their trades? The next thing to look at is those management fees, and here benchmarking can really assist this, seeing if you're in line with the market rate for your investment product. As well as that, when you're in a pooled mandate, it's always good to look at those miscellaneous cost items and drill down into those costs, such as administration, compliance, and distribution-related fees. And finally, performance fees. You've always got to look at those performance fees in relation to the net return that you're receiving for your investment manager, and make sure that those performance fees are in line with your expectations. That's particularly important when you're dealing with private markets.
So I hope you have found our webinar informative. And if you would like further guidance on cost transparency, please check out the PLSA Made Simple guide, which includes a checklist. So thank you very much for listening to us today. We are now available for questions.